47 million Americans are sitting on retirement savings, monthly benefits, or home loans. And a major financial shift is already underway that most people will never see coming until it's too late. What's unfolding right now has happened before in American history, and the people who understood it back then walked away with their wealth intact. Everyone else lost ground quietly, year after year, without a single alarming headline to warn them. The difference between those two groups wasn't income, and it wasn't luck. It was whether or not they understood a specific mechanism that governments use to manage debt without ever asking permission from the people who end up paying the price. Most people think financial danger looks like a stock market crash or a bank failure, something visible, something that makes the news, something you can point to and say that's when it happened. What we're talking about here is different. It doesn't look like a crisis. It looks like your savings account doing exactly what it's supposed to do. The balance goes up. Your statement arrives with a positive number. And underneath that, quietly and steadily, what that money can actually buy is shrinking. That's the nature of what's worth understanding right now, because it determines whether the savings you've spent decades building actually support the retirement you planned for. There's a specific mechanism that the US government has used before to manage its debt burden without raising taxes and without cutting spending. It happened between 1946 and 1974, and it lasted nearly 3 decades. During that period, people who kept their savings in federally insured bank accounts, paid off their mortgages aggressively, and held long-term government bonds, all the things financial advisors told them to do, lost roughly 40% of their purchasing power. Not on paper, not in some market crash. Slowly, quietly, in ways that never showed up on any statement they received. The mechanism is called financial repression. It means the government deliberately keeps the interest rates paid to savers below the actual rate of inflation. Your savings account earns 4%. Inflation runs at 6%. Every year, the gap eats into what your money can actually buy. The number in your account goes up, what that number can purchase goes down. And it happens without any visible event, without any vote in Congress, and without any announcement that most people would recognize as a warning. It requires no legislation. It generates no headlines that say your savings are being eroded. It simply works through the mathematics of the gap between what you earn on your money and what prices are doing in the real world. This isn't speculation about something that might happen. This is a documented policy tool with a clear historical record, and the language describing it has started reappearing in official government testimony after being absent for over 4 decades. When specific phrases resurface in Senate testimony that haven't appeared in official federal communications for more than a generation, it's worth paying attention. Not because of the politics around it, but because of what the historical record shows happened the last time those same conditions were in place. To understand why it matters, go back to 1946. Federal debt had reached 121% of GDP after World War II. The government had 4 options. It could default on its obligations, raise taxes dramatically, cut spending deeply or quietly, allow inflation to erode the real value of its debt over time while keeping interest rates suppressed below the inflation rate. It chose the 4th option because it was the only one that didn't require a painful political vote and didn't produce an obvious event that people could point to. It was also the only option that could be sustained for years without generating the kind of public backlash that explicit tax increases or spending cuts would have created. A saver who deposited $10,000 in 1946 into a federally insured savings account saw that balance grow to around $14,700 by 1974. That sounds fine until you account for what happened to prices during those same years. That $14,700 only had the purchasing power of about $6,200 measured in 1946 terms. The saver followed every piece of conventional financial advice and still lost more than a third of their real wealth. They didn't feel it happening because the number on their statement kept going up. The damage was invisible until it had already been done. A borrower who took out a 30-year fixed-rate mortgage in 1946 at 4% experienced the opposite. The real value of what they owed fell by about 60% over the same period because they repaid in dollars that were worth far less than the dollars they borrowed. The lender absorbed the loss. The federal government, as the single largest holder of fixed-rate debt, was the biggest beneficiary. Its debt fell from 121% of GDP in 1946 to 31% by 1974, without a single year of budget surplus large enough to meaningfully pay down the principal. Inflation did the work, savers paid the cost, and almost nobody at the time had a clear enough understanding of the mechanism to protect themselves from it. That's the context for what's worth paying attention to right now. The federal debt burden today has returned to levels comparable to the post-war period. The same arithmetic problem exists. And the same solution, the one that doesn't require a congressional vote and doesn't generate a visible crisis, is the one that history suggests gets chosen when the alternatives are politically unworkable. Understanding that history doesn't require any particular political view, it just requires looking at what actually happened the last time these conditions existed and thinking clearly about what that means for money sitting in conventional savings instruments today. Let's look at 3 real situations that show how this plays out in practice for ordinary retirees. A 72-year-old woman living alone on Social Security and a small pension paid off her condo years ago and keeps her savings, around $80,000, in a federally insured savings account earning 4.2%. That sounds reasonable. But the Consumer Price Index specifically calculated for elderly Americans, which weights medical costs and housing more heavily than the standard index, ran at 5.7% over the past 12 months. Her real return was negative, 1.5%. She lost over $1,000 in purchasing power last year, and it didn't show up anywhere on her statements. Her bank didn't call her, her financial advisor didn't flag it. There was no mechanism to alert her unless she went looking for the alternative inflation series herself. What makes her situation particularly difficult is that there's no escape available within the category of federally insured savings instruments. She can't solve the problem by switching banks or finding a higher yield savings account. Every federally insured savings product operates within the same nominal rate environment. The only path to a different outcome requires moving outside that category entirely into instruments specifically designed to track actual inflation rather than nominal interest rates set by policy. If the gap between her savings rate and her actual inflation rate persists for 10 years, she loses roughly $27,000 in real purchasing power from that account alone, while her nominal balance continues to grow and her statements continue to look perfectly healthy. A 67-year-old man outside Phoenix has a 30-year fixed-rate mortgage from 2021 at 3.2%. With about $140,000 remaining. He's been making extra principal payments every month to retire the mortgage early before he turns 75. Under normal financial logic, that's a disciplined and responsible decision. It's exactly what every mainstream financial advisor would have recommended for generations. Under conditions of sustained inflation running above his mortgage rate, it's the wrong move. And the reason why requires understanding what a fixed-rate mortgage actually represents in an inflationary environment. His mortgage rate is fixed at 3.2%. If inflation runs at an average of 5% over the next 10 years, he is effectively borrowing money at a negative real interest rate. The bank lent him dollars in 2021. He repays those dollars over time in currency that purchases less and less each year. The real value of his outstanding principal, what that debt actually costs him in terms of purchasing power, declines every single year without him doing anything at all. If he makes only the minimum required payment and allows that process to continue, the real value of the remaining debt falls by roughly $50,000 over 10 years purely through inflation erosion. Every extra dollar he sends to the bank above the minimum short-circuits that process and voluntarily transfers the benefit back to the lender. The extra $200 a month he's been sending represents a meaningful amount of purchasing power being surrendered for no real financial gain. A 69-year-old man outside Chicago holds about $190,000 concentrated in 20 and 30-year Treasury bonds. His advisor put him there because long-term government bonds are considered the safest possible allocation for someone who can't afford to lose principal. That logic was sound during the 1980s and 1990s when the Federal Reserve was actively fighting inflation by keeping interest rates elevated. Bondholders benefited, savers were rewarded. The entire conventional wisdom around conservative retirement portfolios was built on that experience. When the policy environment reverses, when rates are deliberately held below inflation, long-duration fixed income becomes one of the most damaged categories a retiree can hold. His nominal balance may stay relatively stable. The dollar figure on his statement may even grow slightly as coupon payments accumulate. But what that balance can actually purchase declines year after year in a way the statement never shows clearly. Over 10 years of this environment, his $190,000 could lose between $60,000 and $95,000 in real purchasing power. The advice that built his portfolio was appropriate for a completely different policy environment. And almost no one in the financial advisory industry has updated their recommendations to reflect the shift. These aren't edge cases. They're the standard situations that tens of millions of retirees currently find themselves in, holding the exact assets that conventional wisdom built over decades of a specific policy environment that is now changing. So, what do you actually do about it? The first step is to understand your exposure clearly before making any moves. Pull every statement you have, retirement accounts, bank accounts, brokerage accounts, and add up everything you hold in cash, savings accounts, certificates of deposit, money market funds, treasury notes, treasury bonds, corporate bonds, and bond mutual funds. That total is your fixed income exposure. For most retirees, it's between 60% and 90% of total assets. That's the portion structurally positioned to lose real purchasing power if inflation stays above nominal interest rates for an extended period. You need to know that exact number, broken down by account and instrument type, before you can make any informed decision about repositioning. This isn't complicated. It takes about 15 to 20 minutes with your existing statements, but most people have never done it because no one ever told them they needed to. The second step is to stop accelerating mortgage payoff if you hold a fixed-rate mortgage at a rate below 5.5%. This is counterintuitive because eliminating debt feels financially responsible, and in a high-rate, low-inflation environment, it is. But in an environment where inflation is running above your mortgage rate, the mortgage itself functions differently. The interest you pay is nominal. The purchasing power erosion of your remaining principal is real. Every month you allow that dynamic to continue, time is working in your favor. Reset to the minimum required monthly payment and redirect what you were previously sending above that to inflation-protected instruments. The discipline of that extra payment doesn't disappear. It just gets pointed at something that actually benefits from the current environment rather than something that doesn't. The third area involves two specific instruments that most retail investors are aware of, but relatively few actually hold in meaningful quantities. Series Y savings bonds, commonly called I bonds, adjust their interest rate every 6 months based on the official Consumer Price Index. They're exempt from state and local income tax, and the interest is also exempt from federal income tax when proceeds are used to pay qualified higher education expenses. The annual purchase limit is $10,000 per person electronically, with an additional $5,000 available if you direct your federal tax refund into paper bonds. A married couple working together can move $30,000 per year out of low-yield savings instruments and into inflation-indexed bonds using this method alone. Treasury inflation-protected securities, commonly called TIPS, adjust their principal value semi-annually based on the Consumer Price Index and carry no annual purchase limit. They're available in 5, 10, and 30-year maturities through Treasury Direct or any standard brokerage account. For someone with significant savings in certificates of deposit or money market accounts, the practical sequence is to max out I-bond purchases first for the tax efficiency advantages they carry, then direct remaining funds into TIPS with maturities matched to when you actually expect to need the money. A person who is 70 years old with $150,000 in certificates of deposit should start by purchasing the maximum I bond allocation and then build a TIPS ladder with maturities spread across the next 5 to 15 years so that portions become available at regular intervals without forcing an early sale. The fourth step is to verify whether your pension adjusts for inflation. Social Security does. The annual cost of living adjustment is protected by statute. Most corporate pensions and a large share of state and local government pensions do not include automatic inflation adjustments. A pension that pays $1,500 a month today with no inflation adjustment has the purchasing power of approximately $900 per month in 10 years if inflation averages 5% annually. That's a $600 per month decline in real income over a decade, and it happens invisibly because the nominal payment never changes. Call the pension administrator and ask specifically, is my benefit adjusted annually for inflation? And if so, which index is used and is there a cap on the annual adjustment? If the answer is no adjustment, you need to know the exact dollar amount of purchasing power you'll lose over your expected retirement horizon and build a compensating position in inflation-protected instruments to offset it. There's also a tax provision that the overwhelming majority of eligible retirees never take advantage of. When I-bonds are redeemed and proceeds are used to pay qualified higher education expenses for the bondholder, their spouse, or a dependent, the interest accumulated on those bonds is exempt from federal income tax in addition to the state and local exemption that already applies. For retirees with grandchildren approaching college age, this creates an opportunity to purchase I-bonds now, hold them for several years while they earn inflation-adjusted returns, and redeem them when the grandchild enters college to pay tuition directly to the institution. If income thresholds are met, all the accumulated interest comes out completely free of federal tax. For a married couple purchasing $30,000 in I-bonds annually over 10 years, the amount of interest that could be withdrawn tax-free through this provision is substantial, potentially tens of thousands of dollars that would otherwise be taxable income. No other common investment vehicle available to middle-income households provides a federal income tax exemption on interest earnings. Most people eligible for this provision have never heard of it because it doesn't get discussed in the mainstream financial media, and most financial advisors either don't know about it or don't think to raise it with clients who are still years away from having grandchildren in college. One specific mistake is worth understanding in detail because it's the one that takes a recoverable situation and makes it permanent. When inflation rises and bond yields shift upward even modestly, the market price of existing long-duration bonds falls. Someone holding $100,000 in a long-duration bond fund might watch the balance drop to $85,000 and sell to stop the bleeding. They now hold $85,000 in a money market account, earning 4% while inflation runs at 5.5%. The sale locked in a $15,000 loss, potentially created a taxable event, and moved them into a position that loses real purchasing power at exactly the same annual rate their bond fund was losing it, just without any possibility of recovering to par value at maturity. The panic response accomplished nothing except making the loss permanent and removing the option to wait it out. The more effective sequence is to sell long-duration bond positions inside tax-advantaged accounts first, where capital losses don't create tax consequences, and immediately reinvest proceeds into TIPS or I-bonds. In taxable accounts, those sales should be staggered across multiple calendar years to manage the tax impact, and every dollar that comes out should move directly into inflation-protected instruments rather than sitting in cash as an intermediate step. The difference between executing that sequence thoughtfully and doing it reactively during a moment of market stress can represent $40,000 to $80,000 in real purchasing power over a decade for someone with a $200,000 portfolio. the historical record from the post-war period offers one additional observation worth keeping in mind. Between 1946 and 1951, the Federal Reserve formally capped Treasury yields at 2.5% for long-term bonds, while inflation ran between 3 and 8% annually. During those years alone, savers holding government bonds lost approximately 25% of their purchasing power. The current situation has one meaningful difference from the post-war period. The post-war era featured a young, growing population entering peak earning years, which produced economic growth that partially cushioned the impact on living standards. Today's demographic picture is different, with a large and growing retired population that cannot respond to purchasing power erosion by increasing labor income. That makes the stakes higher for retirees specifically, and it makes the adjustments worth making more urgent rather than less. The practical starting points are clear. Complete the fixed income audit so you know your actual exposure by instrument type and account. Stop any extra mortgage payments if your rate is below 5.5% and redirect that cash flow to inflation-protected instruments. Open a Treasury Direct account if you don't already have one. The setup process takes about 20 minutes and requires a Social Security number, bank account information, and a mailing address. Purchase I-bonds up to the annual limit for yourself and your spouse. Begin repositioning long-duration bond holdings toward TIPS or shorter-duration instruments in stages over the next several months rather than all at once. Call your pension administrator to verify inflation adjustment status and get the specific answer in writing. If you work with a financial advisor, schedule a conversation specifically focused on inflation protection, I-bonds, and TIPS. If your advisor isn't familiar with the historical context of financial repression or dismisses the topic without substantive engagement, that's useful information about whether you're getting advice calibrated for the current environment or advice built on assumptions that no longer apply. The core issue here is not complicated once you see it clearly. When the interest rate paid to savers is consistently held below the actual rate of inflation, cash and fixed income lose purchasing power every single year, regardless of what the nominal balance shows. The statement looks fine, the number goes up, and the real value of what that number can purchase goes down steadily and silently over years. That happened for nearly 3 decades in American history. The people who understood the mechanism and adjusted their positions accordingly preserved their wealth and in some cases improved it. The ones who kept following conventional advice designed for a completely different policy environment lost ground slowly and permanently without ever receiving a clear signal that anything had gone wrong. The information needed to protect yourself is publicly available. The instruments that provide inflation protection are accessible to any retail investor through standard accounts that take minutes to open. None of this requires sophisticated financial knowledge or access to products that are only available to wealthy investors. It requires understanding what's happening clearly enough to make a handful of specific, concrete adjustments to how your existing savings are positioned, and making those adjustments before the window where the terms are most favorable closes.